Right now, inside your 401k account, there is a number that most Americans have never looked at. It is called the expense ratio. And according to data from the Center for American Progress, that one number, that one small percentage, could be quietly removing more than $100,000 from your retirement over the course of your career. The number is not hiding. It is right there in your account, but it is buried inside fund details that most people never open. And because it is deducted automatically, a little every single day, it never shows up as a charge. It never triggers a notification. It just slowly, silently reduces your balance year after year. My name is Jack Sterling, and in this video, I am going to show you exactly what an expense ratio is, how much it is actually costing you in real dollar amounts, why it ends up in your account in the first place, and the specific steps to fix it starting today, using options that are already inside your existing plan right now. Let me give you the actual numbers so you understand the full scale of what we are talking about. A study by the Center for American Progress found that a median income two-earner household will pay an average of $155,000 in 401k fees over their lifetime. Not from bad investments, not from a market collapse, just from fees. $155,000. Now here is how those fees work. Every single mutual fund inside your 401k charges something called an expense ratio. This is an annual management fee expressed as a percentage of however much money you have invested. It is deducted from the fund's value every single day in tiny increments. You never see a separate charge. It is not a line item on your statement. It simply reduces the fund's daily return, silently, automatically, every day the market is open. According to Morningstar's 2024 fund fee study, the national average expense ratio for actively managed mutual funds, which are the type most commonly offered inside employer 401k plans, is approximately 0.68% per year. Some plans include funds that charge 1% or even higher. Now compare that to index funds. The Fidelity Zero Total Market Index Fund charges 0.00%. Zero. Vanguard's equivalent, the Vanguard Total Stock Market Index Fund, charges 0.03% per year, not 3%. 0.03%. That is 3 cents for every $100 invested per year. And here is what makes this particularly concerning. A 2023 survey by TIAA, one of the largest retirement plan providers in the country, found that 71% of Americans do not know what fees they are paying inside their retirement accounts. 71%. That means the majority of people watching this video right now are being charged a fee they have never once looked at. Now let us move to the first major section. And I want you to really pay attention here because I am going to walk you through the actual math so you can see exactly what this costs in your own numbers. I am going to compare two people. Both are identical in every way. Same age, same income, same 401k contribution, same market returns. The only difference, the only variable, is the expense ratio of the fund they chose. Both people invest $500 per month into their 401k. Both do it for 30 years. Both earn exactly 8% average annual market return before fees are applied. Everything is the same, except for one number. Person A chose a typical actively managed mutual fund inside their 401k. That fund charges a 1% annual expense ratio, which is not unusually high. It is actually around the industry average for actively managed funds. After that 1% fee is applied, their real net return is approximately 7% per year. After 30 years of $500 per month at 7%, their account balance is approximately $567,000. Person B chose the low-cost index fund available inside the same plan. That fund charges 0.04%, which is common for index funds at Fidelity or Vanguard. After that fee, their real net return is approximately 7.96% per year. After the same 30 years, the same $500 per month, Person B's account balance is approximately $678,000. The difference between Person A and Person B is more than $111,000. Same contributions, same market, same 30 years. The only difference was the expense ratio. $111,000 gone. Not to the market, not to taxes, but to fees. And that gap grows as your balance grows. When your 401k reaches $300,000, a 1% expense ratio costs you $3,000 per year in fees alone. At $500,000, it costs you $5,000 a year. Every single year. Money that could have been compounding on your behalf is instead compounding for the fund company. But here is what nobody is telling you. The fee problem inside your 401k is almost always fixable right now. Without leaving your plan, without triggering any taxes, without any penalties. The solution is already sitting in your fund menu, and I am going to show you exactly how to find it in just a few minutes. And if this information is opening your eyes, hit that subscribe button right now. We release new financial investigations exactly like this 3 times every single week. It costs you nothing, and it could change everything about how you think about your money. This brings us to what I consider the most important part of this entire video. Because once you understand why high-fee funds end up in your 401k plan, you will never look at your retirement account the same way again. When a company sets up a 401k plan for its employees, it hires what is called a plan administrator, a financial services company that manages the platform, the record-keeping, the fund menu, and the compliance. Think companies like Fidelity, Vanguard, Principal, Empower, or T. Rowe Price. These plan administrators are often compensated through what are called revenue-sharing arrangements. Here is how that works. A mutual fund company, say a large asset manager, agrees to share a portion of the expense ratio it collects from your account with the plan administrator in exchange for being included in the fund menu. This practice is legal. It is disclosed, but it creates a direct financial incentive to include higher fee funds in the plan rather than the cheapest options. In simple terms, a fund charging 1% has more money to share with the plan administrator than a fund charging 0.04%. And that difference in revenue sharing can influence which funds appear in your plan's menu. A 2023 analysis by Brightscope, the company that rates and ranks 401k plans, found that the highest rated plans in America, which tend to be offered by large employers like Google, Microsoft, and Amazon, carry average expense ratios below 0.10%. Meanwhile, plans offered by small and mid-sized businesses routinely carry funds averaging between 0.8 and 1.2%. If you work for a smaller employer, there is a real possibility that your plan's fund lineup was built in an environment where cost was not the primary consideration. Now, this does not mean your employer is acting in bad faith. Many employers genuinely do not realize the cost difference because they relied on the plan administrator to build the fund lineup. But as a plan participant, you have rights, and the law actually protects you here. The Department of Labor requires that all 401k plan administrators provide every participant with a document called the 404A5 Fee Disclosure Notice. This document lists every single fund available in your plan, its expense ratio, its administrative fees, and its historical performance. Your employer is legally required to send this to you at least once per year. If you have never read yours, or if you have never even seen it, it is worth requesting a copy from your HR department today. Stay with me. This next section is critical because I am going to show you the data on why index funds have such a massive performance advantage over actively managed funds and why choosing one inside your 401k is one of the highest return decisions you can make for your retirement.
Now let us move to the third section, understanding exactly why index funds have such a structural cost and performance advantage. So you understand why this is not just a matter of preference, it is a matter of math. An actively managed mutual fund employs a team of professional analysts and portfolio managers. Their full-time job is to research companies, analyze earnings, study market trends, and decide which stocks to buy and sell. That team, the offices, the Bloomberg terminals, the research, the salaries, costs money. And that cost is passed directly to investors through the expense ratio you pay every year. An index fund, by contrast, does not try to beat the market, it simply owns the market. It tracks a predetermined index, like the S&P 500, which contains the 500 largest U.S. companies, or the total stock market index, which contains essentially every publicly traded U.S. company.
The fund buys every stock in the index in proportion to its market size. There is no research team, no trading decisions, no human judgment. The process is largely automated, which is why it costs almost nothing to run. Now, the critical question is, does paying for all that active management actually produce better investment results? Here is what the data says. According to S&P Global's SPIVA scorecard, which is the most widely cited academic study comparing active fund managers to market indexes, over a 20-year period ending in 2023, approximately 92% of actively managed large-cap U.S. mutual funds underperformed their benchmark index after accounting for fees. 92%. I want you to actually sit with that number for a moment. It means that if you are currently in an actively managed fund inside your 401k, paying higher fees for professional stock selection, the data suggests there is roughly a 9 in 10 chance that a simple, low-cost index fund would have grown your money more over the long term. This is not a fringe opinion. It is not an argument from one analyst or one YouTube video. It is the consensus view of academic finance going back decades. Nobel Prize-winning economist William Sharpe published a foundational paper in 1991 called The Arithmetic of Active Management. His argument was mathematical, not theoretical. After costs, the average actively managed dollar must underperform the average index dollar. It is a logical certainty, not a statistical probability. Warren Buffett, widely considered the most successful investor of the last century, has repeatedly and publicly stated that for most people, a low-cost S&P 500 index fund is the single best investment they can make. In his 2013 letter to Berkshire Hathaway shareholders, he disclosed that his instructions for his own estate are to put 90% of the money in a low-cost S&P 500 index fund after he passes. When the majority of professional fund managers cannot beat the index, and the most celebrated investor alive recommends index funds for ordinary investors, the question is no longer whether index funds are good. The question is why you are not already in one.
Here is exactly what to do. 5 specific steps. No extra cost, no penalties, no account closure. You can start step 1 in the next 10 minutes. Step 1. Log into your 401k account portal today. Every major plan provider, Fidelity, Vanguard, Schwab, T. Rowe Price, Principal, Empower, TIAA, has an online account dashboard. If you have never logged in, your account number and provider name will be on your most recent 401k statement, which your employer is required to send you at least once per year. Log in. That is step 1. Step 2. Find your current fund holdings and look up the expense ratio for each fund you own. It will be listed as a percentage inside the fund's detail page, something like 0.75% or 1.10% or 0.50%. Write each one down. That number is your current annual fee rate on that portion of your 401k.
Step 3. Inside your plan's investment options menu, which is separate from your current holdings, search for any fund that contains the word index. Specifically, look for a total market index fund or an S&P 500 index fund. On most platforms, you can filter funds by type or search by keyword. Check the expense ratio on any index fund you find. In the vast majority of plans, this will be the lowest cost option available. Step 4. If the index fund has a meaningfully lower expense ratio than your current holdings, and I would define meaningfully as anything more than a 0.20% difference, you can redirect your future 401k contributions to the index fund directly inside your account settings. This is typically a 2-minute process. There is no tax event. There is no penalty. There is no rollover. You are simply choosing where new contributions are directed going forward. Step 5. Consider also reallocating your existing balance. Most 401k platforms allow you to exchange your current fund holdings for a different fund within the plan at no cost. This is called a fund exchange or a rebalance. Again, no tax event, no early withdrawal penalty, no fees for the exchange itself. You are moving money between options that already exist inside your plan. Now, if you look through your entire plan's fund menu and genuinely cannot find a low-cost index fund, you have one more powerful option. Contact your HR department or your company's benefits administrator and formally request that a low-cost index fund be added to the plan. Under ERISA, the federal law that governs 401k plans, employers have a fiduciary obligation to ensure plan costs are reasonable. Your written request creates a paper trail. Multiple employees making the same request creates pressure. This has worked at companies across the country. To recap the 5 steps: 1. Log into your 401k account. 2. Find and write down your current expense ratios. 3. Search for an index fund inside your plan's investment menu. 4. Redirect future contributions to the lower-cost index fund. 5. Consider reallocating your existing balance as well. 5 steps. Most of them take under 5 minutes each.
But here is what nobody is telling you. The fee problem inside your 401k is almost always fixable right now, without leaving your plan, without triggering any taxes, without any penalties. The solution is already sitting in your fund menu, and I am going to show you exactly how to find it in just a few minutes. Stay with me. This next section is critical because I am going to show you the data on why index funds have such a massive performance advantage over actively managed funds, and why choosing one inside your 401k is one of the highest return decisions you can make for your retirement. And if this information is opening your eyes, hit that subscribe button right now. We release new financial investigations exactly like this 3 times every single week. It costs you nothing, and it could change everything about how you think about your money.